Welcome to Signal Post Daily, your human-curated, AI-delivered tech and AI news briefing for Sunday, October 26th, 2025.
All right, so today we're tackling the big question everyone's thinking about. Are we in an AI bubble, or is this the real deal?
Yeah, and honestly, that's harder to answer than it sounds. Because on one hand, you've got incredible AI fundamentals. Models actually work. They solve real problems. But on the other hand, the valuations they're getting pretty wild.
Okay, help me understand that better. Like, what does a bubble actually look like versus a boom? How do we tell the difference?
Great question. So the textbook signs of a bubble are astronomical valuations that decouple from earnings, massive FOMO-driven funding, scarcity pumping up prices, and this narrative everyone buys into without questioning it. And you know what? We're seeing a lot of that right now in AI.
But isn't that also true of any transformative technology in early days? Like, didn't the internet look crazy too?
Absolutely. And that's where it gets murky. Reuters actually compared today's AI boom to the late 90s. And by some measures, it's even more extreme than the dot-com bubble. We're talking valuations relative to revenue, concentration of capital into a handful of winners, that kind of thing. You've got this handful of companies, basically NVIDIA, OpenAI, and the major cloud providers, capturing most of the value while everyone else is chasing crumbs.
Wow. So are you saying this bubble is definitely going to burst?
I'm not saying that. Here's the thing. Some economists are sounding the alarm, comparing it to dot-com. But others push back and say the fundamental difference is that AI actually works. GPT-5 isn't vaporware. These models generate real value. In the 90s, a lot of companies had no revenue model at all. They were just burning cash on eyeballs and hoping for acquisition.
But didn't a lot of companies survive the dot-com crash too? Like Amazon was basically valueless on paper back then.
Exactly. So the pattern history suggests is this. There's a hype cycle, valuations balloon, eventually reality catches up, things correct, but the actual infrastructure and technology that was built, that becomes the foundation for the next wave. The fiber networks from the dot-com era literally became the internet backbone of today. Trillions of dollars of wasted investment turned into the plumbing that powered everything that came after.
Right. So let me shift gears here. Let's talk about what's actually driving this boom, the hardware side. Because I've heard GPU supply is absolutely constraining everything right now.
Yeah, and this is a really important part of the story that doesn't get enough attention. All the software excitement, all the model innovation, it's all powered by GPUs. And there's massive demand. McKinsey estimates AI-ready data center capacity is growing at 33% annually through 2030.
33%. That's huge. But what happens when supply catches up? Don't we usually see price corrections when supply matches demand?
That's exactly the risk. Right now, GPU scarcity is actually inflating the value of AI infrastructure. Everyone's scrambling to secure chips. There are waiting lists stretching months. But if new architectures emerge that need less compute, or if AMD or other players really ramp up production and break NVIDIA's near monopoly, you could see that dynamic flip pretty quickly. And here's the thing. If companies suddenly have cheap access to compute, the economics of scaling AI change dramatically. What was a justified expense at scarcity prices becomes way less compelling when GPUs are commoditized.
Okay, but there's also the energy angle here, right? I mean, aren't these data centers consuming enormous amounts of power?
They really are. We're talking about individual AI training facilities consuming as much electricity as tens of thousands of homes. And that's just training. When you scale inference across millions of users, the power demands become genuinely staggering.
Wait, hold on. Isn't that actually a structural constraint nobody's really talking about? Like, power grids have limits. You can't just infinitely scale power consumption.
That's a really fair question. You're right. Power infrastructure is the bottleneck nobody wants to admit. You can build more data centers, you can order more chips, but you can't just will a power grid into existence overnight. It takes years.
So in some ways, energy scarcity could actually be the thing that naturally corrects this. It's not about software or hype. It's about physics.
Yeah, I mean, you're making me think about that differently. It's not just a financial correction, it could be a physical limitation that forces people to be smarter about compute efficiency. That might actually be healthy.
All right, so let's talk about something else that's been bugging me. All this investment, all this hype, but are companies actually making money with AI yet? Are they seeing real ROI?
So that's where things get really concerning for the boom narrative. An MIT study found that about 95% of organizations are getting zero return from enterprise AI solutions right now. Zero.
Wait, 95%? That's a lot. Can you put that into perspective?
Good call. When we say enterprises, we're looking at companies with more than 100 million in annual revenue. When we say zero return, we're talking P&L impact from the AI solution. Individual productivity is being enhanced by consumer-grade tools like chatbots and code assistants, but it hasn't been enough to impact P&L of these larger enterprises.
So why are they still spending?
It's partly FOMO, frankly. Nobody wants to be left behind. CFOs are allocating budgets because they're terrified of missing out, not necessarily because they have a clear use case. And the problem is, that can't sustain forever.
Right, so help me understand the gap. Why is ROI so elusive? Is it a technology problem or a strategy problem?
It's a bit of both. Some organizations struggle because their data is messy. AI models need clean data, and most legacy systems have a mess of it. Others don't have a clear use case. They're like, we want to use AI, but they haven't actually figured out what problem to solve.
But some companies must be seeing wins, right? Who's actually making this work?
You're seeing wins in specific sectors like healthcare, finance, and certain operations optimization plays. But they're not the majority. And honestly, that talent shortage piece is real too. You need people who know how to actually deploy and maintain these systems. That's not easy to find.
So if 95% of enterprise AI solutions aren't bringing returns, what does that mean for the market? Won't valuations eventually reflect that?
They probably will, yeah. And that's when you could see a meaningful correction. CFOs are going to start asking harder questions. If spending on AI isn't translating to actual revenue, expect the investment to dry up pretty fast. The narrative around AI is so strong right now that it's masking this reality. But there's only so long you can tell the board, we're investing in the future, before they want to see numbers on the balance sheet. And when that reckoning comes, it could be swift.
Which brings us to the last thing I want to dig into. If this does correct, what's left behind? What actually survives?
This is actually kind of optimistic. During .com, all this fiber infrastructure got built for nothing, or so it seemed. But then it became the backbone of the modern internet. Fiber that looked like a wasteful investment became invaluable.
So you're saying the massive data centers being built right now could be the fiber of the AI era?
Exactly. These silicon cathedrals, as people are calling them, might look like ghost assets in a correction, but they are computing capacity. Somewhere down the line, when use cases become clearer and real applications emerge, that infrastructure could be incredibly valuable.
But not all of it will survive, right? Some of these bets are going to be bad?
Oh, absolutely. Some data centers will be underutilized, some models will become obsolete, but the pattern suggests that enough of it sticks around to enable the next phase. Plus, you could see commoditization of compute. Excess capacity becomes cheap surplus compute that enables smaller teams to do interesting things.
And the talent? The researchers, the engineers building this stuff? That doesn't disappear either.
Right. The human capital is actually pretty valuable and durable. Even if certain companies or projects fail, the expertise and experience stays embedded in the ecosystem.
So we could see a world where some of this infrastructure survives a correction and actually becomes the foundation for something more sustainable and real.
I think that's genuinely possible. The bubbles that do the most damage are the ones that create nothing. But this time, even if valuations collapse, there's going to be real infrastructure, real models, real data assets left standing.
That actually makes me feel a little better about the whole thing. Even worst case, we're building something?
Worst case, we're overbuilding. But building, yeah. And the question isn't really whether we're in a bubble.
It's probably yes, to some degree. The real question is what survives and what gets built along the way.
Yeah, I like that framing better. This has been really helpful for me to think through the layers here.
Thanks for pushing on all of this. And thank you, friends, for listening. And we hope you enjoyed our Sunday edition. We'll be back tomorrow with more of what's happening in tech and AI.
You've heard our take. Join the conversation by emailing comments and questions to feedback@signalpostdaily.com. We'd love to connect.
Your input is valuable. If there's something you want to hear more or less about, we'd love to know. Give some input and help steer the show. We hope you're having a great weekend.
Bye-bye.